Have you ever wondered how the Federal Reserve creates money? It's a question that sparks intrigue, isn't it? With the wave of a magic wand, the Federal Reserve, or the Fed, as we'll fondly refer to it, seems to make billions, even trillions of dollars materialize out of thin air. But, as you may suspect, the reality is far more complex and far more interesting. Let's take a moment to understand what the Fed is. Established in 1913, the Federal Reserve serves as the central bank of the United States. Its primary role? To regulate the flow of money and credit in our economy. And yes, part of its job involves creating money. Now, when we talk about money, we're not just referring to those paper bills adorned with the faces of past presidents. We're also talking about digital money, the kind that exists as numbers on a computer screen. Both forms are a crucial part of our modern economy, and both are created by the Fed. But here's where it gets fascinating. The process of creating money isn't whimsical or arbitrary. It's a carefully calculated decision made by the Fed to influence the economy. And this process is what we're going to unravel in this discussion. Think of the Fed as a money-making machine. A machine with the power to increase or decrease the monetary base, which is the total amount of currency in circulation and reserves held by banks. The Fed doesn't just decide to crank up the machine on a whim. It takes into consideration various factors like the state of the economy, inflation, and unemployment rates, to name a few. And let's not forget about interest rates. They play a crucial role in the context of creating money. The interplay between interest rates and the monetary base is a dance of economic forces, a dance that we'll explore in depth. So, how does the Fed go about creating this money? Let's dive in. Scene script. Picture this. A world where money is not just a series of numbers on a screen, but physical bills and coins. It's not too hard to imagine after all, it's the world we live in. But have you ever wondered how this paper money comes into existence? Well, it all starts with the Federal Reserve's decision to increase the monetary base. This usually happens when they want to stimulate the economy, such as during a recession. The Fed basically decides to create money out of thin air, a concept that might sound like magic to some, but it's just economics to others. Once the decision is made, the Bureau of Engraving and Printing steps in. This bureau, a part of the U.S. Department of the Treasury, is responsible for producing all of the nation's paper money. The Bureau uses a process that involves printing, cutting, and inspecting the bills to ensure that they are perfect. The printing process is fascinating. The Bureau uses specially made currency paper, which is different from the paper in your notepad. It's composed of 25% linen and 75% cotton, with small blue and red security fibers embedded throughout. This gives U.S. currency its distinctive feel and added durability. The next step is the actual printing. The faces of the bills are printed using green ink, while the backs are printed in black. The serial numbers and the Treasury and Federal Reserve seals are overprinted in color, which varies depending on the denomination. After printing, the bills are cut from large sheets into their individual sizes, inspected for any defects, and finally bundled into stacks ready for distribution to the 12 Federal Reserve banks around the country. These banks then distribute the money to other banks, which in turn get the money into your hands. The creation of paper money is a complex and meticulous process, one that balances the need for security, durability, and usability. It's a process that not only puts money into our wallets but also powers our economy. But in our digital age, paper money is only half the story. In a world where financial transactions are increasingly digital, how does the Fed create electronic money? Well, the process is quite fascinating. You might think that the Federal Reserve, or the Fed as it's commonly known, has a magical wand that it waves to create money out of thin air. In reality, it's a complex process that involves banks, reserves, and a whole lot of trust. Firstly, let's discuss the role of banks. Banks are the main players in the creation of digital money. When you deposit money into a bank, it doesn't just sit there. The bank takes a portion of that money and lends it out to other customers. This is where the concept of money out of thin air comes into play. When a bank lends money, it doesn't physically hand over cash. Instead, it credits the borrower's account with a digital representation of the money, effectively creating new money. But wait, there's more. The bank is required to keep a portion of the deposit as a reserve. This reserve requirement is set by the Fed. The rest can be lent out, and this is where the magic happens. Each time the bank lends money, it creates more money in the economy. This is known as the money multiplier effect. This process can continue in a cycle, creating more and more digital money. However, it's not without limits. The Fed regulates the amount of money that can be created through the reserve requirement and other monetary policy tools. So what about the reserves themselves? They're an essential part of the process. The reserves are deposits that banks keep at the Fed. They serve as a form of insurance, providing banks with a safety net in case of unexpected withdrawals or financial uncertainties. So we've learned how the Fed creates both paper and digital money, but when does it decide to do so? When does the Federal Reserve decide to create money, and why? This question leads us into the heart of the decision-making process at the Federal Reserve, a process that balances several key factors to maintain the health and stability of the U.S. economy. One of the primary factors influencing the Fed's decision to increase the monetary base is the state of economic conditions. When the economy is booming and businesses are thriving, there's often less need for the Fed to pump additional money into the system. Conversely, during periods of economic downturn, the Fed may decide to increase the monetary base to stimulate economic activity. Another significant consideration is the rate of inflation. If prices are rising too quickly, the Fed might pull back on money creation to keep inflation in check. But if inflation rates are too low or even negative, the Fed may decide to increase the monetary base, as this can help to push inflation rates back up to their target level. Unemployment levels also play a crucial role in the Fed's decision-making process. High unemployment rates can indicate a sluggish economy, and in such situations, the Fed often decides to increase the monetary base in an attempt to stimulate job creation and reduce unemployment. Now let's talk about interest rates, a key tool in the Fed's arsenal. Interest rates and the monetary base are like two sides of the same coin. When the Fed wants to stimulate the economy, it often lowers interest rates, making borrowing cheaper and encouraging spending. This in turn increases the monetary base. On the other hand, when the Fed wants to slow down the economy or curb inflation, it raises interest rates, making borrowing more expensive and discouraging excessive spending, which decreases the monetary base. In summary, the Federal Reserve's decisions about when and why to create money are influenced by a number of factors, including the state of the economy, inflation rates, and unemployment levels. The relationship between the interest rate and the monetary base is a crucial aspect of the Fed's decision-making process. Interest rates and the monetary base, two sides of the same coin. Now let's delve into this analogy a bit more. The monetary base, or the amount of money in circulation, is directly controlled by the Federal Reserve. On the other hand, interest rates, the cost of borrowing money, are indirectly manipulated by the Fed. When the Fed increases the monetary base, banks have more money to lend, which can lead to a decrease in interest rates. Conversely, when the Fed decreases the monetary base, banks have less money to lend, which can lead to an increase in interest rates. These changes in interest rates can have a ripple effect on the economy. Lower interest rates can stimulate economic growth by encouraging borrowing and investment. Higher interest rates, however, can slow down the economy by making borrowing more expensive. As you can see, the process of money creation is a complex and fascinating one. So, we've covered a lot of ground today. We've delved into the fascinating world of the Federal Reserve, the United States money-making machine. We've discussed how money, both paper and digital, springs into existence, seemingly out of thin air. We've uncovered the decision-making process that influences when and why the Fed increases the monetary base. We've also highlighted the pivotal role of interest rates. As we've seen, they're not just arbitrary figures, they're integral to the process of money creation. They serve as a lever that the Fed can pull to control the monetary base, impacting our economy at large. In essence, the Federal Reserve's role in creating money is a complex yet fascinating process, one that marries economics, policy, and a dash of alchemy. It's a perpetual balancing act, a dance of numbers and policies that holds the American economy in its hands. What do you think about the process of money creation by the Federal Reserve? We'd love to hear your thoughts in the comments below.